This is the exact formula sheet provided on the CFP exam. If you're looking at these equations and then thinking, yeah, these look familiar in the same way that actor looks familiar. Well, in the next 30-ish minutes, we're gonna go through each of these formulas, transforming them from that guy in The Hobbit or Love Actually to whatever his name is. We're gonna walk through each equation, what it actually means, how to use it correctly, and the memory tricks that'll make these some of the easiest points you'll score on test day. Now, before diving into the individual formulas, it's helpful to take a minute to understand how the sheet is organized. This sheet may look intimidating at first, but there's somewhat of a logical flow to it. The formulas are not completely random. They're roughly organized into conceptual groups that flow across and down the page. Starting at the top, we have dividend valuation models. These are two equations that really are just the same one rearranged, and they help you value stocks based on their dividends. Moving down, we have portfolio statistics, 5 formulas that help us understand risk, correlation, and variability between two securities. Next, we have the capital asset model pricing and performance metrics. These 3 help determine expected returns and evaluate portfolio performance. In the middle, there are 2 bond formulas for understanding how bond prices change with interest rates. And finally, at the bottom half of the page, we have various return measures, formulas that calculate in different ways, well, averages basically. So now that we've got the big picture view, let's walk through each of these formulas one by one. I'll explain what they each mean, when to use them, and how to apply it on exam day. The first equation on our sheet is the Gordon growth model. This formula helps you price a stock based on its expected dividends. Let's start by breaking down what each of these variables mean. V is the stock value or price. D1 is the dividend. Now, this is critical. When you buy a stock, you are entitled to the next dividend, not the most recent one. And this is one way that test takers get tripped up by a simple formula. If you're given the dividend, chances are you're going to need to calculate D1, and you do that by multiplying the dividend you were given by 1 plus the growth rate. Now, in the denominator, we have R, the required rate of return. That number is set by you or your client, and then G is the expected constant growth rate of the stock's dividends. Let's walk through a simple example. ABC Co. is paying a $2 dividend. Investors expect that to grow by 4% annually. Your client requires a rate of return of 7%. What price would they be willing to pay for the stock? So we've got V equals 2 times 1 plus 0.04 divided by 0.07 minus 0.04, which is 2.08 divided by 0.03. Punch that into a calculator and you get 69.33. Now, conversely, we can calculate what the market's expected rate of return is by using the second equation. And again, this is just the first equation rearranged for R, except for whatever reason they decided to swap out P, stock price, instead of V, stock value. Now, if we go back to the example, the stock is currently trading at $68.75. So we plug that in. R equals 2 times 1 plus 0.04 divided by the stock price of 68.75 plus the growth rate of 0.04. That gives us 0.0703, or a little over 7%, which makes sense because it's slightly higher than what our client's desired rate of return is, and the stock price was slightly lower than our client's required price. So on the exam, when you see steady dividends, stock price, and growth rates, you know that these are the formulas you're looking at. You might be asked whether a stock is suitable for your client given their rate of return, if a stock is over or undervalued, and what the implied return is for a given dividend stock. Now let's move to the next group of formulas, portfolio statistics. These formulas are essential for understanding risk and how assets are related to each other in a portfolio. Let's break down each formula in this section, starting with covariance. Covariance measures how 2 things move together. Now, you're probably more familiar with correlation, or coefficient of correlation as it's sometimes called. Correlation is a standardized version of covariance, so it ranges from -1 to +1. Covariance is a bit less intuitive. You can have a covariance of 17 or -5 or really any number. But as you'll see in the next few questions, covariance is a helpful term that's actually used in other calculations. Let's talk about the equation itself. We've got cov ij, which is the covariance between assets I and j, rho ij, which is the correlation between those assets, again, that can range from -1 to +1, and sigma I and sigma j, which are the standard deviations of assets I and j. Now, before we go any further, let's address the Greek in the room. While it might be helpful and certainly very fancy for you to remember that this is rho, not the letter P, or this is sigma, it kind of doesn't really matter. Yeah, the S in sigma is supposed to connect to the S in standard deviation, but if you want to remember this as swirly twirly, I mean, go for it. Okay, now let's walk through a simple example of covariance. If asset A has a standard deviation of 10%, asset B has a standard deviation of 15%, and their correlation is 0.3, what is their covariance? We just plug it in and we get covariance equals 0.3 times 0.1 times 0.15, which is equal to 0.0045. Now this is positive covariance, which means these assets tend to move in the same direction. Now, on the exam, you're likely not going to get a question that actually asks you to calculate covariance. Instead, calculating covariance will be a sub-step in part of a larger question. Because as we're going to see now, covariance is used in a number of financial formulas, starting with a portfolio standard deviation. So if the last formula helped us understand how two assets move together or not, this formula describes what the combined portfolio moves, its variability. So let's take a look. We've got sigma p, or the standard deviation of the portfolio. This is a measure of portfolio risk. W1 and W2, which are the weights of asset 1 and 2 in the portfolio. Now, for the purposes of the exam, portfolios will just have two stocks. So W1 plus W2 will always equal 1. And then we have sigma 1, sigma 2, which are the standard deviations of each of those. Finally, covariance, which we just talked about. But let's walk through another example. Asset A makes up 60% of our portfolio, so W1 equals to 0.6, and has a standard deviation of 20%, so sigma 1 equals 0.2. Asset B makes up the remainder of our portfolio, so W2 equals 0.4, and has a standard deviation of 30%, so sigma 2 equals 0.3. The correlation between these two is 0.5. Now, when you see problems like this on the exam, pay super close attention to whether the question gives you correlation, rho, or covariance, COV. When you're given correlation, well, you're going to have to do a two-step problem because you're going to need to calculate covariance first. So let's do that here. Going back to the previous equation, covariance equals 0.5 times 0.1 times 0.3, or 0.015. Now we're going to plug this into our formula. So we've got the square root of 0.6 squared times 0.2 squared plus 0.4 squared times 0.3 squared plus 2 times the weights, so 0.6, 0.4, and the covariance we just calculated, 0.015. Simplifying that a little, we get the square root of 0.0036 plus 0.0144 plus 0.002. And again, if we add up all those decimals, we're getting 0.0252. We take the square root of that, and we get 0.1587. Now, really important here is that when you punch this into your calculator, well, remember to punch in everything and punch it in correctly. Now, something to look out for in this calculation is punching in this insanely long equation into your calculator. A trick to keep in mind is that W squared sigma squared is actually the same as W times sigma, and that whole thing squared. You're also going to want to make sure that you always take the square root at the end. For questions like this, you are guaranteed that one of the wrong answers will be the value of not taking the square root. That's an easy one to mess up. Now, all this rho, sigma, standard deviation stuff, it can jumble together. So I recommend taking some time and making yourself flashcards with all the variables. So maybe one side has the Greek, say the symbol for sigma, and the other side has the plain English, standard deviation. You might also want to take it one step further and put some of these equations onto flashcards so that you can associate the rough outlines of the equation with what they mean. So one side will have the crazy formula of standard deviation we just talked about, and then the other side will say standard deviation of two assets. And maybe also the note that you got to make sure that you have either correlation or covariance. Now, don't take the time to actually memorize the exact formulas. You don't need to do that, it's on the sheet. But what you want to make sure is that when you see the formula, you know what it means. And so something else to keep in mind is that, as we're going to talk about, not all the equations on the formula sheet are likely going to show up in the exam. So really, you're looking at being able to identify maybe of the 20 equations, 10 or 12 of them. All right, let's move on to the next equation, beta. Beta is a measure of how much a specific asset correlates with the market as a whole. Now, by definition, the market has a beta of 1. It perfectly correlates with itself. A security with a beta of 0.1 means it also correlates perfectly with the market. When the market goes up by X%, the asset also goes up by X%. Negative betas exist, and that means an asset goes the opposite direction of the market. So a stock with a beta of negative 0.3 means it's moving in the opposite direction of the market and in a magnitude smaller than the market. Chances are pretty good you're not going to have to calculate a stock's beta on the exam. Instead, you're going to be asked to interpret it like we just did. So let's go through the equation anyways. We've got beta I, or the beta of the asset, CAPM, the covariance of the asset and the market. And again, covariance, like we saw, is just a helpful thing that shows up in other equations. Sigma I and sigma M are the standard deviations of I and the market. And then rho IM, or the correlation between asset I and the market. Again, ranging from -1 to +1. Now, moving on to our next formula, this is the standard deviation of returns, or basically just plain old standard deviation. It's the same formula you would see in any normal statistics class, which means now is a good time to pause and talk about, well, what the heck standard deviation even means, because it comes up a lot in finance. Standard deviation is simply a measure of how much variation or whiplash there is, and in this case, in your investments. This is easier to understand with an example. So imagine you've got 2 investments, both average 8% returns, but how they get there is very different. Investment A is a steady performer, consistently giving returns between 6 and 10%, let's say, year after year. Investment B is a roller coaster. So some years it's giving you 20%, other years it's giving you -10%. Both can average to 8%, but investment B will have a higher standard deviation. Think of standard deviation like a DEVA metric. It tells you how dramatic your investment is behaving. Is it consistently delivering close to its average, small standard deviation? Or is it constantly stealing the spotlight with extreme highs and crashing lows, or having a high standard deviation? A lower standard deviation means more predictable returns, while a higher standard deviation means more volatility and risk. This is why standard deviation is one of the most important measures in finance. It helps us quantify risk in a single number. Now, with that in mind, let's take a look at this equation. The standard deviation is the sum of the difference between each observation and the average divided by the number of observations. That's squared and then square rooted, so that negative numbers, years when return is less than average, they don't cancel out years that are positive. Now, the best way to calculate this by hand is to create a table. So you've got each year's returns, the difference from the average, you square it, you sum it up, and then you take the square root. The good news is your calculator has a way easier way for you to do this without having to hand calculate all that stuff. You can Google how that works for your specific calculator. But chances are you're not really going to have to calculate that on the exam. That's likely the same case for our next equation, which is the standard deviation of a sample. Now, we just previously talked about if you have all the observations, but if you only have a sample, say you only have some of the returns of a stock for whatever reason, you would calculate the standard deviation almost exactly the same, except the denominator now is not n, the number of observations, and instead it's n minus 1. Let's skip all the math reasons why this is the case, but again, very, very unlikely that you will see it on the exam. Now, let's move on to the next section of equations. We're going to start with the granddaddy of modern financial theory, the capital assets pricing model, CAPM. This was developed in the 1960s by William Sharpe, who won the Nobel Prize for this work, with contributions from Treynor and Mawson. Now, this equation was a breakthrough, kind of like Einstein's E equals mc squared. It looks simple, but it was a paradigm shift. Before CAPM, we saw that stocks were valued based on its expected future dividends. But what happens if there are no dividends? What happens if the dividends are not growing at a constant rate? Well, you're stuck. So in contrast, CAPM uses the return of the overall market and the relative riskiness of the stock itself to price it. So what we've got is RI the expected return of asset I is equal to RF, the risk-free rate. This is the return an investor would earn on something like treasury bills, plus the difference between RM, the expected market return, and the risk-free rate. This is called the market risk premium or market return premium. That's how much I'm getting compensated for taking the risk on the market rather than being safely into T-bills. You take that and you multiply it by beta, which we saw earlier. Again, beta measures how much an asset's sensitive to market movements. A beta of 1 means it's moving perfectly with the market. Greater than 1 is greater volatility, and less than 1 is less volatility. And again, beta can be negative if the asset is moving in the opposite direction of the market. Now, an equation like this is going to be a simple plug and chug, so we're not going to go through an example. Let's move on to the next equation, Jensen's alpha. It measures the excess or extra return on an investment, how much that investment returned above what was predicted by CAPM. In fact, if you look at the equation, that is exactly what it is. Jensen's alpha is equal to RI, the actual realized return of the investment, minus, and this next part should look familiar, the CAPM equation we just went through. So CAPM gives us the expected return of the investment based on the market, and alpha gives us how much the actual performance was above or below that theoretical expectation. Moving on to our next equation, this is the Treynor ratio. It is a relative index, meaning that the exact number really doesn't mean much in the real world, but it's important because you can use it to compare two investments. Now, looking at the equation, in the numerator, we have the portfolio's return minus the risk-free rate. So we've seen this before. This is the excess or extra reward you get for investing in something riskier than a T-bill. And then in the denominator, we have the beta of the portfolio or asset. So what this is saying is, how much risk am I getting for each unit of additional risk I'm taking? It's a risk-adjusted return. And if you're comparing two portfolios, the one with the higher ratio is going to be rewarding you more for each unit of risk. So that's what you want, a higher ratio. Now, I'm going to have us actually jump down on the equation sheet to an equation that looks very similar to this one. This is the Sharpe ratio. And as you can see, the numerator is the same, but the denominator is different. It's standard deviation of the portfolio. So like Treynor, this is a relative measure of performance, but it's standardized against a different metric, standard deviation instead of beta. Why? Well, Treynor uses beta, and beta assumes that the portfolio is sufficiently diversified so that it's moving pretty well with the overall market, i.e. you can use changes in the market to predict changes in the portfolio price. Now, if this is not actually the case, you're going to want to use an alternative measure of risk, in this case, standard deviation. So how do you know when to use beta, Treynor, or to use standard deviation, Sharpe? Well, usually the exam will give you R squared of the portfolio to the market. So if the R squared is high, above 0.7, use Treynor because you can reliably use beta. And if the R squared is low, use the Sharpe ratio. All right, before we move on to this next equation, if you've made it this far in the video, you are probably finding it helpful. So take a second and hit the like button. These videos are a real labor of love, and well, they're not about to go viral anytime soon. So if you've got a friend studying for the exam or you're part of a study group, I'd really appreciate it if you could share this video. All right, let's move on to the next section on the sheet. There are two equations relating bond price to yields. Now, this first equation is a modified duration. It's kind of tricky to understand intuitively, but let's give it a try. Now, duration is a time measure. So a duration of 7, for example, is a duration of 7 years. And this particular type of duration tries to approximate the change in a bond's price for every 1% change in yield. So if, for example, a bond has the modified duration of 7 years, for every 1% or 100 basis points change in yield, we'd expect the price to move 7%. Now, luckily, as with many equations on the sheet, you are not going to have to hand calculate modified duration. But just in case, let's talk about the variables that go into it. We've got Y, which is the yield expressed as a decimal, C is the coupon rate of the bond, and T is the time to maturity in years. Now, this next equation takes all of that and builds on the concept. It says that the change in price of a bond is a function of its duration and change in yield. And we can see that just that. We've got the percent change in price, delta P divided by P, is equal to negative, because remember, bond prices and yields have a negative relationship. So negative duration times the change in yield. Delta yield divided by 1 plus yield. Now, generally, again, you're not going to have to calculate duration in the exam. It will be given to you. However, there's a very good chance that you're going to have to calculate how the change in yields impact a bond's price. And this is the equation to do it. All right, let's move on to our next section, return metrics. Now, this first equation, IR, is information ratio. Like Treynor and Sharpe, it is a relative ratio. So the exact value doesn't have much meaning. It's about comparing two values against each other. And if you look at the equation, it looks very similar to Sharpe. In the numerator, we have excess or extra returns, so the portfolio returns minus the benchmark returns. And then the denominator, we've got standard deviation again. In this case, standard deviation A. What is A? Well, I think it stands for active. So the standard deviation of the difference between the portfolio and the benchmark. Now, information ratio tries to quantify the performance of an actively managed portfolio against its stated benchmark. Sharpe, if you recall, measures a portfolio against the risk-free rate. So Sharpe is saying, how am I doing in the risk-reward trade-off between me and my T-bills? This measures how well a money manager is doing against, say, a benchmark like the S&P 500. Now, like Sharpe and Treynor, chances are pretty good that you're going to be asked to interpret rather than calculate the ratio. And again, in all of these cases, you want a higher ratio. You want more returns for each unit of risk you're taking on. All right, let's talk about EAR, or effective annual rate. This takes a nominal or headline rate and converts it into the effective rate when you take into consideration compounding. And looking at the equation, we've got I, the nominal interest rate, and N, the number of times it compounds during the year. So say you got a 12% nominal rate that compounds monthly. The EAR is 1 plus 0.12 divided by 12 to the power of 12, and then you minus 1. So we've got 12.68%. Now, in case you're wondering, EAR, yeah, it's basically APY. EAR is more of like the, I guess, academic term, and APY is more of the consumer-facing marketing term. Now let's move on to TEY, tax equivalent yield. Now, I really wish this formula had actually come right after the bond equations, because that would make more sense, but here we are. This formula lets you calculate the pre-tax yield that would be equivalent to a tax-exempt yield after accounting for taxes. Basically, it lets you compare tax-free municipal bonds against corporate bonds. Now, tax equivalent yield is equal to the tax-exempt rate divided by 1 minus your client's marginal tax rate. Now, let's say you're looking at a 4% tax-exempt municipal bond and wondering what is the equivalent yield on a corporate bond that you would prefer, and your client is in the 35% marginal tax bracket. So we've got TEY equals 0.04 divided by 1 minus 0.35, or 6.5%. So you would need to find a corporate bond offering more than 6.5% to prefer it over the municipal bond. Now, as you can see from this example and from the equation, the higher your marginal tax rate, the higher the corporate bond needs to be for you to prefer it. And that's why municipal bonds are particularly attractive to higher income clients. All right, we are in the home stretch. Only 4 more equations left because we've already covered Sharpe. Now, these last few equations are all different, kind of fancy looking ways of calculating average. So we start with AM, or arithmetic mean. This is the simplest one out there. And really, this is the average that you learn in grade school. So you take all the observations, add them together, and divide by the number of observations. Why is this in the equation sheet? I mean, who knows? Maybe just to make it look complicated, because again, AM is just your normal run-of-the-mill average. Now we're gonna skip Sharpe because we already talked about that, and we're gonna move on to the next equation, which also looks a lot trickier than it actually is. This is geometric mean, or time-weighted rate of return. In fact, this equation and the one below it are basically the same ones. As you can see, we're taking 1 plus the return from each year, multiplying those together, and taking the nth root, which is also can be expressed as 1 divided by n, the power of 1 divided by n. Same thing, and that's actually what you would do in your calculator. So these equations are basically the same thing. And finally, you're going to subtract 1 to get the right percentage that you're looking for. Now, like arithmetic mean, the math looks way trickier than the concept. I mean, if I were to ask you, what is the annual return of an asset that I've held over n months, you would know how to calculate it, and you would basically do exactly what this equation says. It just looks fancier in the formula. Now, as you can see in the first formulation, they've got E of R, that's like expected return of R. Again, it really kind of doesn't matter if it's expected future return or actual return. Essentially, it's all the same thing. All right, our last equation, HPR, our holding period return. Now, looking at this equation, it looks a lot like our last one. You're taking 1 plus the return of an asset for each time period, but here we're not taking the nth root, meaning we are not normalizing or standardizing to annual. So the equation is basically saying, how much return did I get on an asset over n periods? That's it. So if I had 7% returns, then 5 the next, and then 8 the next, you would take all of those and you'd get 1.2338, you minus the 1, so you get about 21%. Now, is that a good return? Well, that's hard to know until you have to compare it against something. And again, you're probably not going to have something else that you've held for 3 years. You've probably held something else for, I don't know, 2 years, 5 years, or whatever. So again, that's why holding period return is not particularly useful and why you would want to use the previous equation, geometric mean. So if we take our example and we raise it to the 1 divided by 3, or divided to the third, we get 1.66666. You minus the 1 and you get a 6.67% return. Now you can compare that against other assets that you've held for other time periods. We did it. That was the last equation on the CFP exam formula sheet. Now, hopefully at this point you have a much better understanding of which equations will actually show up on the exam and the handful of gotchas you need to look out for. By the way, that actor, Martin Freeman. Also, he was Watson in the Benedict Cumberbatch Sherlock series. Highly recommend. Now, if you're looking for more study material, check out this video next. I've also got a playlist of other videos on my channel. I'll see you in the next one.